I'd like to say good morning, good afternoon to different people across the United States. Please put your mute button on at this time. And I'd like to say welcome. I guess we're going to call it the Waterfront Fireside Chat now. Change the positioning of where we set up. Like to hope everybody's having a great summer. It seems like the second quarter was the quarter to open up. Restaurants are crowded. If you've been to an airport, airports are crowded. And it seems like there are people back on the street now. Want to say thank you, a huge thank you with the amount of people we have been introduced over the past 8 to 10 weeks. We've had more referrals, more introductions to family than we've ever had in the history of Waterfront. Enjoy seeing everybody stopping by. We've started to see a lot more people stop by lately. I've enjoyed that and getting to know new people. So how we're going to work, Mike Shields, Senior Director, is going to give us an overview of the quarter and the first 6 months. Then Chris Harrington will give us an update, more of a detailed market update. And at the end, Chris and I are going to talk about the OS/OE portfolios, why we use small and mid cap in the portfolios, and how we find those companies that we use in the portfolios. So at this time, I'd like to turn it over to Mike Shields, our Senior Director of Waterfront, to let him get started. Mike?
All right. Good morning, everyone, and good afternoon to anyone on the Eastern time zone. My name is Mike Shields. I'm the Senior Director, and I'm a Certified Financial Planner here at Waterfront. Just a couple of housekeeping things. I still hear a couple of people's sound. So if you guys wouldn't mind, please click on the mute button at the bottom of your screen or wherever it may be. And then also, if you have any questions that you want to ask, we're going to have you all everybody be on mute to the end. But if you have questions, click on the chat button at the bottom. That'll open up a little area where you can type in questions, and we'll address those during the Q&A here at the end. So as Roger said, I'm just going to start off today with a quick overview of some of the big picture items we've seen over the last 6 months. One, where have returns been coming from? Then take a look at the interest rates and how much they've moved. And then lastly, I'll touch briefly on inflation. And then Chris is going to touch on what that means for investors. So we'll jump into our first slide here and take a look at some of these returns.
Can you see?
All right, fantastic. So if you take a look here, let's take a look at 2020. 2020 probably had the biggest discrepancy we've ever seen in regards to growth stocks outperforming value. You'll see here on the left-hand side of these boxes, the value stocks are represented, and it goes from large caps down to mid cap, down to small cap, and same over on the right-hand side, only with growth stocks. During this pandemic, of course, everyone gravitated towards tech stocks because that's what everybody was using. And not only did that happen, the amount of day trading doubled, the amount of people sitting at home trading doubled, and they pushed those stocks probably higher than they needed to be. But you'll see here we had complete outperformance on the growth side of things. But now look at the first 6 months of this year. It's completely flip-flopped. We've got large cap value outperforming by about 50% over growth. The mid cap space has doubled, and the small cap space has tripled performance-wise over the first 6 weeks. So we've seen this shift taking place, and most of this shift started taking place the first week in November. That was when the first vaccine started hitting the market.
Value stocks are what we want.
So also, if you're not on mute, please mute for us. Next slide. All right, so on this slide here, what I wanted to do is kind of show you guys the history of what this performance looked like. If you'll see here, from 2015 through 2020, large cap and mid cap growth stocks have outperformed. Keep in mind that we've all heard about market cycles. This outperformance that we've seen the last 5 or 6 years, the question is whether or not we think that's going to continue. And really, we don't think so. With rising interest rates, rising inflation, that is very good for financials, cyclicals, industrials, and these are all value companies. So we welcome this development because most of our models are tilted towards the value side. Go ahead and take a look at the next slide. All right, so this is a chart of our 10-year treasury over the last 2 years. But if you take a look at this right in the middle of 2020, back in August, this rate was down at 0.5% and moved up over 1.7, and then we've had a pullback as well. I really just say this because for you bond investors, remember, when rates go up, bond prices go down. The Barclays Aggregate Corporate Bond Index was negative over the first 6 months of this year. The reason I bring that up is having a managed bond portfolio during this type of environment where interest rates are moving all over is key to making money in fixed income during this type of environment. So that's all I got on interest rates. And next, we're going to look at inflation. Inflation, you can't turn on the news, go to the grocery store, or even go buy a car right now without inflation being an issue for you. And of course, the biggest debate is whether or not this is transitory or if it's here to stay. Chris is going to hit on this topic here in just a few minutes, but I saw this graph the other day and I thought it was great. This graph is showing what it takes if you've got $100,000 sitting in savings account to keep up with inflation. So let's just look from 2009 on. We're just going to look at the right half of this chart. Look at all those little blue bars, those horizontal bars. It's telling us that you needed to get about 2% or $2,000 off of $100,000 in your savings account just to keep up with inflation. That means just to be able to buy the same amount of milks, eggs, bread the next year as you did the year prior. The problem with that is someone who's been sitting on $100,000 in cash the last 12 years, they've been losing 1 to 1.5% purchasing power every single year. Now, to make things worse, here's what this inflation is looking at. Look at the very last blue bar on this chart. Now, instead of needing $2,000, you need almost $3,800 to keep up with inflation if it stays where it's at right now. And cash is paying 0.8%. It's just not going to cut it. So, like I said, just keep an eye. The person that inflation hurts the most, the investor it hurts the most, is the people sitting in cash. People that had that $100,000, maybe it's grown to 103 or 104, but that $100,000 purchases have gone up to about 120 to 125,000 due to inflation, and that could just get worse. So those are some of the big topics we're going to hit on, but I'd like to hit them from a high level view first. With that, I'm going to turn it back over to Roger and Chris.
Thanks, Mike. Appreciate that. At this time, Chris Harrington, our Chief Investment Officer, is going to go over some graphs and some details about the past 6 months.
Hello, everyone. Okay, the first slide we're going to start with is the high price to earnings ratio of S&P 500. Over the past decade, there has been solid earnings growth, not exceptional earnings growth, but solid earnings growth of the S&P 500. But really what has juiced the returns has been the expanding multiple. Long-term stock returns are determined by earnings growth and dividends. Expanding multiples, it's sort of an ebb and flow type dynamic. You can go through decades where they contract and you can go through decades where they expand. But we're certainly in a decade where they expanded. The lower right chart will give you some indication of that. That red and blue line, you can see that's not a graph of what the S&P 500 is doing. It's not the graph of earnings growth. That's a graph of the multiple folks are willing to pay for those earnings. And it's risen to a pretty high level when it's a little bit concerning. Coincidentally, you can see in the previous decade, the 2000s, that red line going down. And that was a decade where investors really did not want to pay up for stock prices. So the multiple investors were willing to pay came down over that decade, and that led to the 0% return over that decade. It really does matter what investors are willing to pay for those earnings. We're at a pretty high level right now. So that does concern us as we look forward into this decade. We don't believe you can generate stock returns from an ever expanding multiple. We know interest rates are very low, and that has had the effect of driving up that multiple, but still they're at what we believe to be a high enough level that the chance of driving returns from an expanding multiple are slim. That being said, there is a good chance we're going to see earnings growth this decade. I don't think we'll see above trend growth, but there is a very good chance we'll see earnings growth, and there's a modest dividend to be paid by S&P 500 companies. So you can still generate a decent return in S&P 500 stocks. Just these double-digit returns that we've become accustomed to in the previous decade, those are very likely in the rearview mirror. Those came from investors bidding up stock prices, not necessarily earnings growth. So I want people to understand that is sort of a transitory effect. And going forward, you really need strong earnings growth to drive stock returns. So what I'm showing you here is real interest rates. If you've listened to us talk before, you've heard us say that real interest rates are inflation, are the nominal interest rate, which you hear in the news, and 10-year Treasury is currently 1.2%. But then if you subtract the inflation rate, that gives you what's referred to as the real interest rate. Right now, the markets are currently pricing in about 1.2% for the Treasury rate, but they're also forecasting an average of about 2.2 to 2.3% inflation for the next 10 years. So that leads you to a negative 1% real return. That's pretty pessimistic. That's the bond investors do not have an optimistic view of the U.S. economy in the upcoming decade. We did see actually Treasury rates move up to about 1.7% earlier this year, even a little bit higher, the 10-year, and then it has since had a pretty strong rally, number of factors driving that. And the bond investors are clearly saying that they think future growth is going to be very weak. Once we get past this stimulus-fueled surge in growth that's occurring in 2021, then the sort of reality sets in. And what drives growth when the government isn't just spending an insane amount of money? And the bond market, at least at this point, is saying future growth is going to be weak. That is diverging from what the stock market is saying. So there is definitely a diverging camp of viewpoints, and that will play out as we get into the fourth quarter and into 2022. The markets are very skewed by Federal Reserve activity. We have seen what I'm showing you right here is quantitative easing started back with Ben Bernanke after the Great Recession, and the Fed grew its balance sheet about $4 trillion in assets over about 7 years, and then they started slowly stalling that and actually contracted a little. But then we saw with COVID, the Federal Reserve has just been buying securities at just an incredible rate. It took 7 years to get $4 trillion on the balance sheet. They added another $4 trillion in about 1 year. That is just such a phenomenally fast rate of adding securities. They're continuing to buy today, by the way, and that is supposed to be stopping at the end of this year. We likely will, but we'll find out as we'll get more detail here. Probably actually the Federal Reserve meeting in Jackson Hole will give some clues into that. Why will they probably stop buying securities? Well, it's been a little too much in our opinion, but inflation fears are strong enough to get the Fed to stop buying later this year, though interest rate increases could still be way off. They have a dual mandate to remind everyone: inflation and jobs are both their primary concerns. Whether we get transitory inflation or more lasting inflation, I'm going to talk a little bit about that going forward. But there probably is enough out there where the Fed should be stopping to buying securities. It does matter. Those excessive liquidity positions drive up stock prices. We talked about that higher multiple. 2018, there was some Fed tapering, and that actually led to a stock sell-off in the latter part of 2018 for those that remember. So we're keeping an eye on the Fed. The Fed really does matter in today's markets. So inflation, everyone's talking about inflation these days. This is get into some of the detail for some of the folks that care about that. Transitory versus sticky argument. Certainly a lot of people in the Federal Reserve are saying, oh, we have transitory inflation caused by supply shocks. And that is true. Certain industries such as autos. What I'm showing you on these graphs is sort of the weighting of various components of CPI. And that is on the left side with the numbers, and then on the right side is sort of the year-over-year increase. So some things like used cars and trucks are the most talked about, 45% year-over-year increase. The shortage of new autos and the effects of COVID were driving some demand for used cars, and especially the stimulus payments allowing folks to afford used cars a little bit better, has driven a surge in used cars. And other areas are showing similar surges. Those are supply chain constraints. Those are transitory. Used cars are not going to have another year going forward that they had in the past year. So, and by the way, some of these smaller categories like used cars, they've been punching their weight way above where they should. There's been a small percentage, 10 to 13% of categories driving this surge in inflation, and some of the bigger categories aren't there yet. But that doesn't mean that the bigger categories can't sort of take the baton and run with it going forward. Some of these bigger categories, and I'll point you to owner's equivalent rent. It's a 24% category. It's sort of an odd category that's somewhat tied to housing prices, but it has a rent sort of component to it. Well, if this surge in housing prices does have the effect of pulling up this category, that will lead to more sticky inflation. And some of the other categories, medical care, if everyone sort of gets on board with it's time to raise prices, we can get away with it. Prices aren't necessarily set by the marginal consumer. Then we'll have inflation last a little bit longer. And we are particularly focused on the housing category to see if inflation will last longer. If it does last longer, then the Fed needs to act. They need to keep their credibility, and they're going to have to stop buying securities if inflation doesn't subside toward the end of this year. Well, what is the effect of inflation? Inflation can decimate growth. We are currently, the past 3 months, we now have had personal income growth. Personal income growth drives the economy. It's been negative for the past 3 months because income is not growing as fast as inflation. And so when inflation is higher than income growth, you have negative real income growth. As you can see in the chart below, there's a couple spikes. Real income growth just soared. And those are stimulus months when the federal government was just firing checks at folks. Real income growth just really shot up. And so consumers are in really strong shape. It is concerning to see 3 negative months in a row that you cannot grow an economy when prices are growing faster than income. But there is definitely the wherewithal for consumers to spend in the latter part of this year. And they're also going to start receiving child tax credit payments soon. So that's another sort of dynamic that will add to the finances of consumers. So we're paying attention to this inflation and its impact on growth, but as of now, consumers definitely have the wherewithal to support a growing economy. These are a little bit hard to see graphs if you don't have it on a full screen. I'll talk through these. So 2 things going on. Currency strength, why we don't think the dollar will be able to appreciate much from here. I'll talk to the bottom one first. So this inflation scare that's occurring, the yellow line is the US. You can see that this is inflation. I'm comparing the US to China and the Eurozone. The US is experiencing the surge in inflation right now. it's not present in other nations. And so remember I talked about the real interest rates. When you take the interest rate minus inflation, that is really what determines the driver of currencies. And the US is significantly negative at this point because inflation is much lower in other parts of the world. Actually, China's inflation should pick up, but they're actually running a really low CPI right now. And in Europe, they're not having these same shocks. Why is the US experiencing more inflation? There's been more stimulus. That's part of it. I think the supply chain dynamics are a little bit more troublesome in the US. And I just think we have a mentality of businesses that are going for it. They're raising prices and they're using every opportunity, which isn't necessarily taking place in other parts of the world. The trade deficit is shown above. Another determinant of currency strength is trade of goods and services. You can't see the numbers on the right, but what it's showing you is, we used to run 40 to $50 billion trade deficits monthly, and those have just pushed into the sort of the $70 billion range with COVID. COVID really changed people's purchasing, more goods, less service spending, and that continues. There's a little bit of a switch back to that service spending here as people are getting out and about more, but it's still a significantly negative trade deficit. Those goods, a lot of them manufactured overseas, and the Eurozone actually runs a close to break-even trade balance, and certainly China is very positive. So there's a couple of things that here where we think the dollar strength, that is a little bit of dollar strength recently, will stall, and that ties into some of one of the reasons why we have a high allocation to international stocks. 2Q 2021, just a phenomenal growth quarter. We're going to have nominal growth is going to probably be double digits when you tack on inflation and real growth. And that's just a great scenario for earnings growth. We're going to have we're in earnings season right now. We're going to have very strong earnings growth, but it's likely going to be peak earnings growth and a peak economic growth quarter. And markets have become really accustomed to sort of valuations based on where current growth is. And so as growth forecasts get cut, we are worried that could show up in security prices. So we really have to start thinking about what's the steady state for the US economy. Post this COVID in stimulus that really has just altered things in such a big way. We're an economy that could grow at 2%, pretty steady 2% growth in the previous decade. There's nothing that would indicate we should be able to grow above 2%. I would take a productivity surge that is, in our opinion, not on the horizon. So we believe that the US resorts back to that sort of 2% or possibly below trend growth. And that's going to be coming pretty soon, probably 2022. Please go back for a couple other things. Delta variant, at this point, we're monitoring it. The areas it's impacting are not high GDP areas. It's very concerning for schools, but at this point, we think sell-offs on Delta could create opportunities for buying. And that's how we're playing it, but we're very focused on seeing where this is going. With a lot of workers on the sidelines, we'll get in labor market. We're still 8 million jobs down from pre-COVID. We will see how that pans out once we get into the fall. Summer's over. In most states, the unemployment benefits will expire. But there is a lot of big skills mismatch in our current economy. So there should be a pickup in hirings, but a surge remains to be seen. Inflation, this bullet about every business using the current environment to try and raise prices. Who isn't? I mean, this is go for it is sort of the mentality out there in corporate America. I'm going to try and raise prices, and paying attention to if that can be sustained. And also consumers. Consumers are in good shape. They have the wherewithal to spend to drive economic growth. Or will that happen, or will the savings rate stay elevated? So that's something we're paying attention to as well. Couple things that can definitely help drive growth that are in the news lately: the infrastructure bill, and it's sort of been separated. This reconciliation bill, which is sort of a lot larger Biden agenda item. That's a much bigger one. Infrastructure bill, talking about 600 billion or so in new spending. And then the child tax credit, I'll hit on that. So we believe some sort of infrastructure bill will get passed this year, probably in the fall, could be a little sooner. That is spending that will occur over the next decade. So that'd be a modest positive for future growth and nothing to be too excited about. The reconciliation bill is much larger, talking 3.5 trillion, though we think that would be watered down to anything that would pass. If that were to pass, that would have a big impact, because that would be a lot of income redistribution, a lot of money spent on certain initiatives that will definitely drive growth. No doubt about it, it's a lot of money, but the pay-fors for that are problematic if you're a stock investor. Higher capital gains taxes, higher corporate taxes, higher taxes on the wealthy, all items that could hurt stock prices. So that's an important one to pay attention to. And then in terms of consumer purchasing, the child tax credit payments are starting this month. And it's a big deal to shore up the financing. It's a lot of money, and it is heading out to households, started in July and will continue on for every month going forward. So long-term sustainable growth is driven by productivity and growth in labor force. So touching on the last bullet here, labor force participation trends were unfavorable before COVID and look even bleaker now. A lot of people dropped out of the labor force. A certain percentage, good percentage of older workers are just decided time to move on and try new things. So we have some demographic challenges, and certainly immigration has been on the low side. So we have some demographic challenges to labor force participation. So what really we need is significant surge in productivity. There are actually some promising signs there. Technology trends are good. The old adage, don't ever waste a good recession. And companies are using COVID to drive labor productivity. They have doing more with their current workforce. That is a trend that's at least playing out currently. The questions remain if that can continue to be the case. But just at a really high level, we definitely have some concerns, and I sort of speak to that in some of these smaller bullets. Has this addiction to large deficit spending become an uncontrollable animal that politicians can't get away from? You know, sustainable economic growth doesn't come from mailing out checks to people to spend. It comes from productivity improvement. And, you know, sometimes it can take a country a reset for politicians to really grasp that message. And I don't know if it comes through the Fed, sort of, which has been playing alongside the government for the past decade, largely not being on the same side as them. And that could lead to a reset. But certainly, you know, this game of mailing out checks to spend is not sustainable. Some allocation considerations. We believe the correction in value stocks is occurring in July on growth and Delta fears will stall, and these stocks will provide opportunity going forward. So we've seen a nice snapback over the past 2 days and some of the sell-off in some of the value stocks. It is our opinion that COVID pulled forward demand for a lot of growth stocks. They happen to be in areas that really benefited from COVID. but we don't think that their current growth rates are indicative of future growth rates. We think a lot of demand has been pulled forward. And as we get into 2022, 2021 should still show strong growth. We think growth rates start stalling there. International locations, much different spot when it comes to recovering from COVID. The US is, had access to really good vaccines early, which was, very good for our country. The Europe and other international locations are really just starting to get their vaccination rates moving, and they'll end up surpassing the US in not too distant future. And meanwhile, a lot of the stimulus, especially in Europe, is just starting to get going. So they're going to have a situation where they have a highly vaccinated population with stimulus just starting to kick in. So things look pretty good, we think, on the international markets for that's economic growth, and certainly their stock prices compared to earnings are at a much lower level than the US. We do think on the positive dynamic for the US will be a passed infrastructure bill, and base case right now is a watered down reconciliation bill that will help to keep growth sustained into 2022. But again, the pay fors need to be paid attention to. Corporate and capital gains taxes go right to the stock market. And consumers, they're going to be willing to spend in the latter part of 2021, and that should help keep growth stable as we get to the end of this year. So that, I believe, is it. I don't know if we have any questions, but happy to answer any.
Great. Chris, what we'll do is you can send your questions in and we'll review those a little bit later here. I want to get into quickly going over the OS opportunistic strategy and the OE opportunistic equity strategy. The OS strategy, for short, what we call, is now going to be coming up on 5 years in August that we've been running that portfolio. That portfolio is a minimum of 250,000. It has both stocks, bonds, and some individual ETFs in the portfolio. Usually 60 to 72 stocks, 75 stocks in the portfolio. And then our OE, opportunistic equity portfolio, has a $100,000 minimum and usually runs between 48 to 55 stocks in that portfolio. A lot of the same stocks will be in the OE. I look at the OE as the best of the best picks that we like at this time. Both of these have had an incredible year this year. If you would be interested in those returns and knowing more detail about that, email Trent Grisham. He's our business development director. Trent can get you all the information about those portfolios and their returns, and also some of the top holdings. Those portfolios, we will be closing at about 100 million in assets. We're approaching, as we approach that. At this time, I kind of want to go over what sets the portfolios apart from a S&P standard type of portfolio. We have a small and mid cap exposure in the portfolio. Chris, tell us a little bit about why we have that.
Well, the whole premise of the OE and OS was to really be a good complement to the S&P 500. We don't think the S&P 500 is diversified enough, and certainly heavy weightings to large growth tech companies. And so we think it's appropriate to be more diversified, and they're to the market that aren't as followed. And we're looking at there are large cap companies in the OE and OS, certainly a healthy share, but we're focusing really on a lot of small companies and mid companies and trying to find some gems out there.
What we have found is a lot of the larger firms, due to size, your research firms have kind of not following at all the small and micro cap type of companies anymore. The resources, they don't want to allocate resources to those companies. A lot of the mutual funds are unable to pick those companies up. So, and it's also that way in the bond world too. Some areas that we're able to use in the OS portfolio, we can bond wise, we can pick up because our nimbler size. A couple of the stocks in the portfolio, Chris, tell us a little bit about Darrell and Capstone Mining.
Well, I have an allocation to Canadian small caps. I think that it provides some good value. So Capstone Mining is a copper miner. They're a smaller company with a lower valuation than bigger peers, and in my opinion, not rightfully so. They actually have sort of a hidden asset in Chile that's really valuable. It's an undeveloped mine, and so I focused on that particular company due to that asset, and they also have some assets in Mexico that are not, in my opinion, not properly valued. So I wanted exposure to copper. How do you get exposure to copper? Well, you screen all the names. You know, what makes the most sense? I think the Canadian copper companies look pretty compelling, and some of the small cap companies had, in my opinion, better asset base. So went in that direction. Darrell, actually, that was a COVID pickup. I actually not a huge fan of management there, but they just set such a compelling stock price during COVID. They make bicycles and furniture, and actually some baby gear. So they're one of the largest players in juvenile car seats and those type of things. But their biggest asset is Schwinn, Cannondale, those type of bikes. A lot of bicycle brands. Certainly, bicycle sales soared during COVID, so that was a good one. And then actually, furniture picked up too. A lot of spending on the home, so they had some good tailwinds.
How did you find a Capstone Mining? How did you find a company like that?
Start saying, how am I going to get exposure to copper? Then you research the copper companies, and you go down the list. And do you want the big ones? A lot of the big ones are not just copper; they're copper, iron ore, a whole mix of different minerals. And so we try and get yourself as pure exposure to copper as you can. That whittles down the list, and then really just reading about the companies. What are their assets? What are their earnings power, and what can they do? And that takes you to Canada when you look at sort of the best valuations. And it's pretty easy to use Bloomberg to run these searches and find these copper companies, who they are.
When you're reading them, what reports do you look at for the companies?
Well, several reports. You got to read the financial statements. So read the financial statements. Then every company's going to have their own sort of marketing presentation book. Take a look at those. Those are informative. Read some transcripts, and then some industry research. Industry research in that particular case would be analysts on on the copper markets and in various companies. So a lot of different things combined.
From time to time, do you talk to management of those companies?
Just the IR department.
IRB, for those that...
Investor relations, for people who don't know what IR is. We don't actually, we're good or bad. The management's always going to tell a positive story. If we're good or bad, we don't really get access. We're not a big enough company, mutual, and get access to sit down with the CEO type stuff. But occasionally I'll talk to investor relations and get some information that way. But that's not relied on. That's a sort of just a occasional source of information.
So we had in the portfolio some activity with Verso and Tribune. What happened on those two companies?
So we get into this. So there is a microcap allocation. It's not very high, but you'll get some microcap stocks, microcap being less than $1 billion, in our opinion. Verso, it's good assets. They can make money with their assets. Verso is in a coated paper, which is used for marketing materials, the stuff that shows up in your mailbox, printed on coated paper. They're the largest position in the US in that, but marketing on paper is not a very good industry, certainly challenges for growth ahead. But that being said, everything has a price. They have some of the best mills in the country, and they can make it at the lowest cost. So that tends to attract private equity. Private equity really focusing in on the asset base, and they can generate cash even in a struggling industry. And so the Tribune as well, news is certainly digital news is growing, but at the same time, newspapers are declining, but they did a great job growing digital subscribers. Anyway, those are two, a lot of the stocks in the OE and OS tend to attract, on the smaller side, have tended to attract in the past private equity interest, and those are two this year that did so.
So Tribune no longer in the portfolio since it was bought out.
Yeah, that was bought out, and Verso has an offer that's higher than where it's currently trading.
Yeah. We have one stock in the portfolio, China Mobile. Tell me a little bit about that, what we're waiting on.
We can talk about that one.
Good and bad.
Yeah, well, we're just kind of stuck with that. It was a small allocation. I allocated 0.5% to China Mobile a while ago. And the US sanctions basically made it untradeable. So we have to figure out, it still trades in the Hong Kong exchange. We have to figure out, how we're going to get that sold. So that's a logistical problem. But on the broader scheme of things, we do have investments in some China stocks, and we have to pay attention to some of this stuff. China Mobile, that's a small allocation. We'll get our money back one way or the other. The stock is doing just fine in Hong Kong. They pay a great dividend, but we can't get it as U.S. investors anymore. But the solar industry is certainly a growth industry, but the best companies for that are in China. And we have some exposure to that. And so this sort of back and forth with the US and China is actually, it's a pretty concerning, something that I'm paying a lot of attention to.
Our allocations over the years have picked up into the international side. Where are we at on international versus US in the portfolio?
I can't give you an exact percentage. It's gone up. There's just more opportunity international. There are companies that do the exact same thing. They'll have assets in Asia, Europe, United States, and sell the same product. So there's some materials companies I'm thinking of here as US counterparts. But they just trade cheaper. It's not like they're only relying on growth in Europe. They're multinationals, and they just trade at a lower valuation. It's just the U.S. investors are just willing to bid up stocks to really high levels. Remember, stock value earnings. Your return is based on earnings growth and dividends over the long term. Short term, juiced up returns from people bidding up stocks are nice. You always want to be in that. But, it's always a forward-looking exercise, and there's lower starting valuations internationally. And we think growth is going to be just as good as the US. Their stimulus is just getting going. So why not have some international stocks?
Yep. Well, with that, we'll kind of close it up here. If you want any more information about those two portfolios, we didn't really hit the other portfolios that we have, our ETF, the dimensional portfolios, and then the active manager portfolios at this time, but we'll hit that in the next quarter or two. But this is something that's a differentiating point with Waterfront, and a lot of you have invested in it, and I thought this would be a good time to talk about how the small and micro cap play a big part of that portfolio. I'd like to thank Mike and thank Chris for their time, and again want to thank you for the referrals that we've been given and the introductions. It's been unbelievable. This has probably been the busiest summer. Usually this time of year things are slowing down, and it has not. So I want to thank you for that. As always, if there's anything, opportunities for improvement, we're always looking at improving our business and how we service you. the client. That's what it's all about here, is the client. That's our focus, is how we manage your assets, how we can be better, how we can make money for you. And if there's anything that you see, drop us a note, let me know. You all have my email. So with that, I'd like to say thank you again, and hope you have a great summer. If your travel is in your plans, or if you just want to stop by.
Are there any questions?
Oh, yeah, were there any questions? Yes. So, no questions. So great. Hey, thank you. Have a great one.